path is one in which inflation returns to target within a reasonable time frame, while the economy continues to grow and we hold on to as many of the gains in the labour market as we possibly can. I think it is still possible to navigate this path, and it's certainly our ambition to do exactly that. But it's a narrow path, and it's likely to be a bumpy one, and there are risks on both sides, and I'll talk about some of those risks this morning. But really what I want to start off doing is to talk about the importance of the destination. That is a sustainable return of inflation to the target range. And I'd also like to talk about our strategy for getting to that destination, including yesterday's decision to increase the cash rate again. I'll then turn to some of the factors that the Reserve Bank Board will be considering as it navigates the return of inflation to the 2 to 3% target range. As you can see in this first chart, the recent inflation readings have been the highest in more than 30 years. The reasons for this are well known. They include the supply side disruptions caused by the pandemic, Russia's invasion of Ukraine, and the very large fiscal and monetary stimulus that was delivered to support economies during the pandemic. And our job as Australia's central bank is to make sure that this period of high inflation is only temporary. And it's really important that we're successful here. High inflation is corrosive and it damages our economy. It erodes the value of money and people's savings. It puts pressure on household budgets, and it makes life harder for businesses, and it distorts investment. Inflation makes us all poorer, and it hurts people on low incomes the most. And if inflation stays too high for too long, it will become ingrained in people's expectations, and then the high inflation will become self-perpetuating. As the historical experience clearly demonstrates, the inevitable result of this would be even higher interest rates, and at some point a larger increase in unemployment to get rid of the ingrained inflation. And the board's priority is to do what it can to avoid this. As you would know, over recent times the Australian economy has been operating at a very high level of capacity utilisation. You can see this in measures of capacity utilisation from surveys, which is shown in the top panel here, but it's also evident in the labour market, which has been very tight. And recently the unemployment rate has been around the lowest it's been in 50 years. It's clear that the level of demand in the economy has been pushing up against the supply capacity of the economy, and this has been contributing recently to the upward pressure on prices. The return of inflation to target does require a more sustainable balance between aggregate demand and aggregate supply in the economy. And the tool that the RBA has to use to achieve this balance is interest rates. I acknowledge that this tool comes with some complications. Its effects are felt unevenly across the community, and rising interest rates are causing significant financial pressures for some households. But this unevenness is not a reason to avoid using the tool that we have. It's certainly true that if the board had not lifted interest rates, some households would have avoided, for a short period, the financial pressures that come with higher mortgage rates. But this short-term gain would have been at a much higher medium-term cost. If we had not tightened monetary policy, the cost of living would be higher for longer. This would hurt all Australians and the functioning of our economy. This would ultimately require even higher interest rates to get inflation to come back down again, and more unemployment. So, as difficult as it is, the rise in interest rates has been necessary to bring inflation back to target within a reasonable time frame. The evidence suggests that the higher interest rates are working and that inflation is coming down. As you can see in this chart, in the March quarter, CPI inflation rate peaked at 7.8%, and it's now coming down. Subsequent to the March quarter, the monthly CPI indicator showed a pickup in the 12-month ended inflation rate in April to 6.8%. This monthly outcome was a little higher than we had expected, but it has not changed the fundamental assessment that inflation is trending lower in Australia. As you can see in this next chart, if we exclude the volatile items and the travel component of the CPI, inflation was 5.5% in 6-month annualised terms in April. That's 2 percentage points lower than it was in October last year. So inflation is coming down. This decline in inflation is also evident in declining prices in global markets. As you can see here, oil prices have reversed much of the increase that followed Russia's invasion of Ukraine, and the prices of many base metals have also declined, as have the prices of many food commodities in global markets, and you can see here the prices of wheat and beef have both come down. Similarly, the prices of international shipping has normalised after the spike during the pandemic. In time, these lower shipping costs and lower commodity prices should be reflected in the prices that Australians pay for goods and services.